Every fortune you have ever envied began as a whisper in a dark room. The year is 1611. Men are shouting in Amsterdam, and they are not trading gold. They are selling pieces of a company that does not fully exist yet. This is the part they never teach you in school. Money learned how to become a rumor, and the rumor made men rich. The Dutch East India Company had done something no one had dared before. It cut ownership into slices and sold those slices to strangers. For the first time in history, you did not need to be a king to own a piece of something enormous. You just needed money and the nerve to bet on tomorrow. This was the birth of the modern share. Not a loan, not a gift. A claim on the future, repriced every single day by fear and hope. The Amsterdam Exchange became the first true stock market on Earth. The idea slipped across the sea into London, and it did not arrive in a palace. It arrived in the dark, inside coffee houses thick with smoke, where the real decisions were never written down. Here is what nobody tells you about the origins of finance. It did not begin as an institution. It began as a rumor mill with money attached. Fortunes were made in those rooms, and fortunes were destroyed there too, quietly, over a single bad whisper. From its very first breath, the market was never about numbers. It was about nerve, and who got to hear the truth first. Across the ocean, a younger nation was about to build its own version of this ritual and hide it in plain sight. In 1792, 24 men gathered beneath a buttonwood tree on a street named Wall. They were brokers. Tired of chaos, tired of outsiders undercutting their prices. So they made a pact, and it was not the pact history books like to advertise. Trade only among themselves. Only on fixed terms. Outsiders need not apply. That agreement, scratched out under a tree, became the New York Stock Exchange. The most powerful financial institution on Earth was not built on fairness. It was built on exclusion. And that is the secret sitting quietly underneath every ticker symbol you have ever watched. For decades, this system moved at the speed of a horse, a ship, or a man running with paper in his hand. Information was power, and power belonged to whoever heard the truth first. The Telegraph arrived, and the old rules of secrecy collapsed overnight. Something even more dangerous came next: the ticker tape. Money stopped being physical. It became a signal, flickering and alive, moving faster than the men who owned it. Railroads exploded across the country, and their stocks exploded with them. But a market with hundreds of moving stocks is chaos, and chaos does not sell fear efficiently. Humans do not fear a spreadsheet. They fear one number falling. So, in 1896, a journalist gave the public exactly that, the Dow Jones Industrial Average. Now, the market had a face. One number to rise and one number to fall, while an entire nation watched it breathe. Once the market became a headline, it became a weapon. In the 1920s, that weapon was handed gasoline. Ordinary people began buying stocks with money that was not theirs, buying on margin. $10 of your own could control $100 of stock. The rest was debt hidden quietly beneath the dream. Then, in October of 1929, the dream collapsed on schedule. Stocks did not just fall, they collapsed, and the debt beneath them dragged everything down with it. The crash did not just destroy wealth, it destroyed trust, and trust is far harder to rebuild. Out of that wreckage, the government did something it had never wanted to do. It decided the market needed rules. In 1933 and 1934, new laws forced companies to tell the truth about their finances, and a new watchdog was created to enforce it, the Securities and Exchange Commission. For the first time, the private club had outside eyes watching it, at least on paper. The risk never disappeared. It simply learned to wear a disguise. After the Second World War, stocks stopped being just a rich man's game. Mutual funds let ordinary workers own tiny slices of hundreds of companies at once and called it freedom. But this expansion had a hidden cost buried in the fine print. Millions of people now needed the market to succeed, not to get rich, but simply to retire at all. In 1971, something happened with no precedent. NASDAQ launched as the first fully electronic stock market. The screens replaced the shouting, and no one noticed the power shifting with them. Then came algorithms, code built to buy and sell on pure pattern, with no hesitation and no conscience. High-frequency trading firms began executing thousands of trades a second, harvesting gaps that exist for less than a heartbeat. The market of shouting and handshakes had quietly become a market of silence and code. And here's the question they would rather you not sit with too long. If the machines get there first, were you ever really invited? With this new machine came new kinds of failure, each one faster than the last. In 1987, Black Monday sent markets crashing in a single day, accelerated by the very programs built to protect them. In the late 1990s, the dot-com bubble inflated prices far beyond reality, and when it burst, trillions of dollars vanished almost as fast as they had appeared. Then, in 2008, the market faced its most dangerous test since 1929. This time, it was not simple speculation. It was a hidden web of mortgage debt, built by people who understood exactly what they were hiding. When that web unraveled, it nearly took the entire global banking system down with it. Governments intervened on a scale never seen before, rescuing institutions deemed too large to fail, while ordinary losses were left standing. In 2020, a new kind of shock arrived. Not greed this time, not debt. A virus shut down the physical world overnight. Markets crashed in days, then, flooded with emergency money, recovered even faster than they had fallen, leaving many to wonder who that recovery was actually built for. Each disaster exposed a different weakness in the same machine: panic, overvaluation, hidden leverage, sudden shock. And each time, the market did not disappear. It absorbed the wound, rewrote its own rules, and kept moving, largely on its own terms. So, what is the stock market after 4 centuries of disguises? It is not simply a place where value is measured. It is a place where belief is priced in real time, and belief has never been distributed equally. Supporters will tell you it is the greatest wealth machine ever built. Critics will tell you it is a system that rewards those closest to the information, the fastest to the data, the deepest in capital. Both of these things are true at the same time, and that is exactly what makes the market impossible to fully trust. Every crash in this story had winners, quiet ones who saw it coming, or built the machinery that made it inevitable. Every crash also had losers, loud ones, who learned the rules only after they had already lost everything to them. The market was never a level field. It was a machine with a public entrance and a private staircase. The stock market did not begin as numbers on a screen. It began as men in a coffeehouse, whispering about a ship that had not yet come home. It is the oldest story in modern finance: hope, fear, and leverage disguised as numbers.